I needed a lot of cost segregation, bonus depreciation, because I had sold all my actives and now I had a big tax bill. And so I focused on that, which, I didn't pay taxes. I deferred all my tax from that. So that was a good strategy.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right. Welcome back to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name's Randy Smith, and I'm your host today. And I am really, really excited to have Jim Pfeifer on with us today. Welcome to the show, Jim.
Thank you. Thanks for having me.
Outstanding. So very, very quick intro for Jim. He is part of Left Field Investors, and he is invested in, I believe, 95 plus syndications. So he is far more of an expert on any of this than I am. So we're just super excited to have him. So Jim, why don't we go ahead and kick it off? And can you tell us a little bit about your background and your path to passive investing?
Yeah, it's a long and twisted path. I think I'm a full-time passive investor now. So this is career number 5, I think. I started off just in business, and I think kind of the theme throughout is education. I've always been interested in educating people. So as soon as I learned a little bit about my first job as a reinsurance underwriter, I started looking for ways to teach or mentor others. And so I worked in that business for about 11 years. And then I did what I always wanted to do, is I became a high school teacher. And I did that for about 7 years. And I realized teachers are amazing. It's a super hard job. And I wanted to educate people, but I wanted people that were more interested in actually accepting the learning. In high school, I didn't want to learn either. So I get it. And then I moved on to become a financial advisor. And that's where a lot of things really opened up for me, because that's an education job as well. But I thought I knew everything about finance. As soon as I got my first job, right, I put the 16% into my 401k, maxing out. I was investing in mutual funds, stocks, all that stuff, because I was a finance major in college, and I knew the way to make money and become wealthy was the stock market. Had to be, right? But when I was a financial advisor, they started teaching us about money. And the more they taught me about money, and at the same time, I became an accidental landlord, because we built a new house, 2008. We couldn't sell it. So we just rented it, and I was managing the rental, and I hated it. But I was learning about money at the same time I was seeing how my real asset was performing, and light bulbs started going off. And so I realized that I wanted to get more real estate. And so I started buying more single family homes. I bought some multifamily homes, and slowly I realized that I always prided myself in advising my clients. I was getting into the same investments they were. But now I was getting so much into real estate that I couldn't really, I couldn't get them into real estate. One, I'm not licensed for it. 2, I don't make any money at it, right? So it was very difficult. And that's when I made the decision to go full-time into what I thought was passive investing, but it wasn't. It was active investing in turnkey properties and multifamily properties and Airbnb. And we flipped a house and made hundreds of dollars, which is not what you want to do when you're flipping out.
Sure.
So, finally, I realized that I wasn't a good asset manager. None of the properties cash flowed like I thought they would, but the market saved me. Everything, went way up in value because it was just such a hot market for everything. Yeah. So then I found syndications, and I thought, this might be it. This might be for me. So I sold all my active stuff, got into syndications, and that's where I feel like I finally found my spot. And that's where we started. Again, the education comes in. We started Left Field Investors. First of all, it was supposed to be a small mastermind, just for a few people local here in Columbus, Ohio, where I live. We were going to meet, dinner club, once a month, have dinner and talk about passive investing. And our first meeting was supposed to be March 18th, 2020. And that was the pandemic. The whole world shut down. So did Ohio. And we never met in person until this October, over 2.5 years later. But what happened was the pandemic allowed us to get online, do Zoom meetings. And so we had some really great guests because everyone was sitting at home with nothing to do. So I could call someone and say, hey, you want to come talk to 20 investors on a Zoom call? and we got some really high profile people, and the group just took off. It was not intentional, but now we're, left field investors. We have almost 1,200 members, and our purpose is to educate and provide a network for people who are interested in passively investing in real estate syndications. And, I'm just a big believer in real assets that produce cash flow rather than, what I was doing before was paper assets, the stock market, where you don't receive a current benefit. You're buying a piece of paper or an electrons, right, on a computer screen,
Right.
and you hold it and you hope later you can find someone else to buy it from you for more than you paid. And that's it. Right. And so I just found that real assets are what got us to financial freedom, which for me is time freedom. And so that's kind of my journey in a nutshell.
Yeah, holy cow! You covered a lot of ground there, and I've got like 12 questions I want to ask here. But so, kind of the first thing that jumps out at me, you mentioned you were one of those students that came out and you knew exactly you needed to put all your money into your 401k. 16% you mentioned at that point, which we're all taught from a very young age in corporate America that take advantage of the 401k. I'm curious what your thoughts are about 401ks today. Now that you've spent the time as a financial advisor, you've done active and passive investments, and now you're fully passive. I'm curious what your thoughts are about 401ks, because I suspect they might have changed as mine have over the last handful of years.
Absolutely. And this is a very personal decision. So if you're a 401k person and that's where you like to put your money, go for it. But for me, it makes no sense, right? Because what you're doing is you are putting money away now in hopes that, taxes will be lower in the future, right? So what you're doing, you're in a partnership with the government, and they can change those rules at any time, right? You're providing all of the money. They're making all of the rules. So you're putting all this money in your 401k, and you're hoping to be in a lower tax bracket when you retire. Number one, I want to be making more money when I retire. So I don't want to be in a lower tax bracket. But even if I am, think about how taxes are historically kind of low, right? The debt and all that is historically really high. So where do you think taxes are going to be when you retire? If you think they're going to be higher than they are now, you are putting money away in a bucket right now that can be taxed now at a lower rate, and you're waiting to tax it at a higher rate later. So I'm not a fan of 401ks unless it's good for people that aren't very good at saving, because if you're just going to take the money and spend it, just do the automatic 401k. But if you're disciplined and you want to learn how to passively invest and do some of these syndications, then I would take the tax hit now, put it in some kind of real estate thing, because if you do that right, you're not going to pay any tax on it.
Yeah, I love it. I love it. Yeah. So thank you for walking through that. It's a conversation I've been having over the last handful of months with really just kind of close friends right now, because I'm still personally trying to process this thing, because I've got 25, 30 years of education beat into my head that take your 401k, take your 401k, take your 401k. And I'm really at this point where I feel like, had I taken all those dollars over the years, paid the tax on them, yes, paying taxes hurts, but pay the tax, and then gradually start putting dollars into alternative investments, I think I'd be in a far better place today than I am currently with those 401k dollars, which we all see how, they say 8% per year is what you're going to get out of that over time. But when you factor in all the fees that you're paying as well, it's probably close to half of that. And if you can't beat 4%, you're not doing a great job with your investments, right?
Well, let me give you an example, right? Let's say that you have $1 million at retirement in your 401k or in some retirement account, right? Unless easy numbers, right? So every financial advisor will tell you the most you can take out is 4%, right? Because that's you need that $1 million to be $1 million on the day you die, because you don't know when you're going to die. So you can't take that money and have it run out, right? So you're taking 4%. So let's assume you're in a 25% tax bracket because you want to be in a lower tax bracket when you retire because you're a 401k person. So now that $1 million, you're going to get 40 grand a year. That's assuming the market doesn't go down ever, which it will. So you're going to take 40 grand out. You're going to be taxed. So now you're going to have 30 grand net, right? And that is the best you will ever do, because your account's never going up because you're taking money out of it, even in a down market. So 30 grand is your high watermark. Now let's take another person who is not into 401k and has $1 million at retirement, and they put it in real estate syndications. fairly easily you're going to get 7% cash on cash return, right? So now you're collecting $70,000. You're going to pay zero in tax if you do it right. And that's the low water mark, because you can expect, every 5 years, probably not anymore, that's the past, every 7 to 10 years, you're going to double your money. So your 70,000 is going to be 140,000 in 10 years, right? Because you're going to have $2 million. Your money's going to keep going up because you're cash flowing and you get appreciation. So to me, it makes no sense not to be in these cash flowing assets.
Yep, I love it. Thank you. Thank you for confirming that. I had a feeling you were going to go down that path, and I lobbed it out there. So, yes, there's a lot of similarities here. You and I have similar backgrounds. I wasn't in a financial advisor, but I was in financial services, and definitely am a big advocate of passive investing now. So let's talk about, if we can, your journey with passive investing. I'm sure, you mentioned, similar to myself, you sold some of your active investments and you shifted those over into syndication. So you had this probably a bucket of dollars that you could start to allocate to the syndication space. How did you go about choosing syndicators? What was your selection process? Did you stub your toes a little bit along the way in doing that? What did that look like?
I didn't stub them. I dropped bricks on them.
Yeah.
So I've gone through 3 stages of sponsor selection, I guess I'll call it. So the first time, as we talked about, I was a 401k guy, right? So when I quit that job, I rolled that over into an IRA. So I had a big bucket of IRA money, and I decided I wanted to be a syndicator when I was transitioning into my active investing role. And so I went to a seminar by the real estate guys talking about syndications. And about an hour in, I realized, nope, I don't want to do this. I want to be the passive guy, because they kept talking about these passive guys. I'm like, that's me. And I took that bucket of 401k rollover money, and I basically walked around that room and said, "Are you a syndicator? My name's Jim. Here's some money." Right? Yeah. I mean, not really, but that's how I evaluated a sponsor. I decided if they were at this syndication seminar, they were someone I wanted to invest in. So I invested in crazy stuff. And none of it I would do again. Some of it worked out okay. Some of it worked out not okay. And I figured out that that's not the way to analyze or vet a sponsor. So then I went to part 2. And I decided I'm going to listen to a ton of podcasts, read some books. And then anytime I hear someone on a podcast, I'm going to call them up and have a conversation. So then I started, I'd have a hour conversation with them. Then they'd send me a deal, and I have maybe another 20-minute conversation about the deal. And then I would have to think, okay, now I'm going to wire 50 or 100 grand to this stranger that I've talked to for an hour and a half and hope that it worked out, right? And so that was much better than my first approach. But when you listen to somebody on a podcast, you don't know if they're a great podcaster, a great marketer, or are they a great asset manager. And there's no way really to know until you invest with them. So results from that, much better than my original plan, but still not that great, right? There's a better way. And that's when, we kind of stumbled in left field investors. We found out that now the way I find new sponsors is I'm not investing with a new sponsor unless they're introduced to me by somebody in my community who I know, like, and trust, who is already invested with that sponsor, right? So what that does is trust transfers. So if I trust this person and they trust a sponsor, okay, I have a great starting point. I still do all the same evaluation and vetting of the sponsor, but I'm starting 100 steps ahead, because now I know if I send my wire, it's going to an actual person who's going to put it into an actual deal, right? That's the first thing. Terror is, are they going to do with my money what they say they are? Now, this doesn't guarantee that all my deals are going to be great. It doesn't guarantee anything, because the person that referred me, I don't require that they go full cycle. I just require that, hey, they've invested with them. They've gotten a few distributions or a few reports, and they're like, yeah, I'm okay. I'm satisfied. I like these guys. So, that's kind of our approach now. I mean, I'll still, if I don't have a referral and I meet somebody, it's just a long process. I tell them it's going to take a year or two for me to get comfortable with you. And so I do that. And most operators are okay with that. If they say, no, I need your answer now, then that's even easier, because my answer is no.
There's your answer. Yep.
Yeah, that's why the power of community, I think, is so valuable. And it doesn't have to be left field investors, but every person who's going to really get into this type of investing, you need a network and a community, because you can't walk out your front door and talk to your neighbor, right? They're going to say, hey, let's talk finance. What are they going to say? 401k, IRA, interest rate on your mortgage. And then you're going to say, oh yeah, but I'm doing these syndications. Whoa, wait a second. Alternative investing? That's crazy. That's scary, right? And to me, alternatives is where you live, where you go to work, where you go to buy stuff, where you store your extra stuff. I mean, all these are real estate investments. So it's crazy to me, but that's why I think you need a network.
I love it. I love it. Thank you. Yeah. And I love the fact that you talk about making sure that you get a referral from somebody else, because there's no better way to know what somebody's doing than to ask somebody that's doing it. And it's interesting. A lot of folks will say that they ask the syndicators for referrals, but we all know if somebody asks you for a referral, you've got 2 or 3 folks on the side that you've probably had multiple conversations with and set the stage that said, hey, Johnny's going to call you. Can you tell Johnny what a great job that we do for you? So those blind referrals, no doubt, are the best way to do that. So thank you for that.
And I talked to somebody who was telling me that they still ask for referrals from the sponsor, because not all sponsors, you're not going to be able to find someone you know and trust that's already invested with them. And what they do is they ask for several different sponsors or referrals. They want someone that's invested with, they say, give me a referral from someone who's invested in multiple deals. Okay. Give me a referral from someone who's invested in your worst deal.
Okay.
And give me a referral from someone who's just invested for the first time. So you're still probably in a situation where you're not getting, true transparency, but at least you're making the sponsor work for it and find people that, hopefully can give you some true ideas. So I still think there's a space for referrals, but as you said, you have to understand what you're really getting.
Yeah. And I think you bring up another great point, talking about either the worst deal or a bad deal or a time that something went wrong. I've had conversations with operators before where they say, I've never stubbed my toe. I've never ran into troubles and everything's gone smoothly. And I very, very quickly and politely thank them for their time and move on my way, because if they haven't made any mistakes, they've not been in this business long enough, and I don't want to trust my dollars with them. So, So now with the large number of syndications that you've done, I can only imagine what tracking that looks like, but do you have a strategy for, X percentage goes into multifamily and a small percentage goes into something else that I'm really just kind of interested in? Or how do you move those dollars around, or do you have strategies that you follow?
Yeah. So first of all, tracking, there's a great new company called Vyzer, Vyzer. And they, just real quick, an aside, they created a platform that is for passive investors and syndications. It does all the it's a wealth management tool. They've incorporated all the other stuff, but it is purpose built for people like us. So I use that, and that's helped a lot. But your question was, how do I, allocate? What's my strategy? And for a while, I didn't really have one. At first, it was, I needed a lot of cost segregation, bonus depreciation, because I had sold all my actives and now I had a big tax bill. And so I focused on that, which, I didn't pay taxes. I deferred all my tax from that. So that was a good strategy, but it wasn't diversifying. So now I try to diversify by sponsor, by asset class, and by market. And then also, before all the debt stuff changed, sometimes I would try to get different kinds of debt or things like that. But mostly it's those 3 categories. And I don't really have a perfect idea yet of, I want 20% here, 20% there. It's multifamily heavy, as most of us are. But I'm really just looking for quality opportunities. And I want to make sure that I'm in a lot of different asset classes. The other thing I'm doing is, right now, I'm still relatively new. I've been doing this for maybe 5 years. So my goal, my strategy that I came up with a few years back was, I'm going to invest in the minimum amount that I possibly can with a bunch of different operators. And what I'm going to do is, because these are long-term illiquid deals where you have no control, right? So I can't tell you after 6 months if someone's worth investing in again, or a year. So what I want to do is invest with a bunch of different people, a bunch of different asset classes, find out which ones are the best. And then after, 5-7 years, when I have a bunch of deals go full cycle, then I can start throwing more money into one particular operator, one particular asset class. And I can kind of I'm trying to learn, right? And that's why what the community does is it fast forwards everything. It shortcuts everything, because, now I don't have to do that as much. I can put bigger amounts in if I want, because I know I have other people who've already done it and can vouch for somebody. So it's a combination.
And I think you have a strategy too about your second investment with one operator, do you still have a period of time that you like to wait before you do that second one?
Yeah, I tried to. I stole that idea from David Shirky, who's one of our left field members and infielder, and that was his idea. He doesn't recommend any operator to anybody or reinvest with that same operator until a year has passed. And I don't stick to it exactly, but I've learned my lesson there as well, because when I found this one syndicator, I just thought, oh man, they're great. And I got into like 5 deals within a month or two, and they've been fine. But what I found was this particular operator has a communication problem and a K1 problem. And that really frustrated. Communication is super important to me. So I got really frustrated. And had I waited a year before I did the second investment, I would have learned that. And so this one didn't lose me any money, but it got me pretty frustrated. And and without these investments, I would have been less frustrated. So that's kind of how I look at that.
Yeah, and I don't think we talk about K1s enough either. One K1 that goes out until the final day can certainly get the heart racing come tax time. So that's a lot of fun too. So I know you have a strategy you like to talk about, the lazy 1031. I'm wondering if you could share that with our audience. I think it's just an awesome strategy.
Yeah. So basically, when I had all these active properties and I was selling them, I went to my accountant, and fortunately, I did this in the beginning of the year because I didn't really realize the impact. But I said, hey, I'm going to have a bunch of gains. Well, what can I do? And he said 2 things. The first thing he said is, Jim, sometimes when you make a bunch of money, you got to pay a bunch of taxes. I'm like, no, that's not the answer I want. And then he said, well, or you can do the lazy 1031. And I said, oh, okay, what is that? And basically, what that is, it's not a 1031 at all. But when you sell an asset, a real estate piece of real estate, you have a gain, a capital gain, right? But when you buy into a syndication, if they do cost segregation and bonus depreciation, you get a paper loss in the first year. And it can be up to the amount of your investment or more, right? So what I did was I took the gains from the properties that I sold and I invested them in new syndications. I got a whole bunch of bonus depreciation, and that ends up wiping out or deferring all of the tax I had to pay. So I didn't pay any tax on all those gains. Well, then people say, well, what about depreciation recapture, right? Because what happens is depreciation is over, different parts depreciate different rates, but 27 and a half years for the main depreciation. So if you sell an asset before 27 and a half years and you took the full 27 and a half year depreciation, the tax man's going to say, you got to recapture that and pay tax on the part that you didn't use. And so for that, what you do is you invest in another deal, right? Because your deal just went full cycle, maybe after 5 years. So then you have this another capital gain, but you take that money and you reinvest in another deal, you're going to get depreciation again, and the cycle starts all over again. So that's the part of it we call the golden hamster wheel, right? You just have to keep investing in new deals, and you will basically defer your tax forever. And one other thing about depreciation recapture, Tom Wheelwright, who's a very well-known accountant in this space, his theory is you're probably not going to recapture near as much depreciation as you think, because if they hold the deal for 5 years, all the short-term stuff, the carpets, the blinds, all that stuff is going to depreciate to nothing, and there's nothing to recapture. So I think when I asked about this, he said depreciation recapture is overstated mostly. People think it's a bigger thing than it is. But basically all you're doing is you're selling one asset, and then with that proceeds, you buy another asset to cancel out those that gain. And it's just easier than a regular 1031 because you don't have any hoops to jump through. All you have to do is make sure that the gains were in the same year as the losses. And the nice thing is, usually when you first start out, you get a whole lot more loss than you do gain because you're just getting these small distributions, right? Nothing's going full cycle. So what happens is you end up stacking up a bunch of losses, and the losses carry over. So all those losses carry over to your future stuff. And it really just works out where if you're doing it right, you can get to where you're paying almost no tax. And that's the situation we're in right now is, we're following the tax code. We're doing what the government wants us to do. And we pay very, very little tax. And tax, one last thing, tax is the biggest eroder of wealth. And if you're not paying it, you're not getting eroded, right?
Yeah, I love it. Yeah, no, thank you for walking through that. It's such a powerful piece to this whole equation. And, I was having a conversation earlier today, like, would you rather make 150 grand a year tax free or 250 grand a year with taxes, and I'll take the tax-free income or tax advantaged income all day long. So
Absolutely.
good stuff. So, and also one thing you didn't allude to, or you alluded to, but didn't mention, as you keep stacking these and you keep pushing them forward, your monthly distributions continue to grow and grow and grow. So I suspect that has something to do with kind of your retire early with real estate syndication strategy as well. Can you talk about that a little bit?
Yeah, so it's amazing how fast this snowball grows, right? So when you think about it, if you do a $25,000 syndication investment into 7 or 8% pref, I think you get $166.67 a month. And you look at that and you're like, okay, what is that? That doesn't really do much. That doesn't move the needle. But the thing is, if you do another one and another one, pretty soon you have $1,000 a month of passive income. Now, one of those deals go full cycle, right? So now you have this big capital influx, and then you invest that in a deal. And now instead of $167 for each one, maybe you're getting $300 for each one. And so the snowball grows so much faster than you can comprehend. And part of it was, I got in at a good time in the market when everything was, turning in 3 to 5 years. Now it might be 5 to 7, but it is still very doable. I think the deal is you have to really plan and strategize for how much capital you can allocate in a year, pick your investments. And if you're trying to, get rid of the W-2, right, you also have to think of the time frames, and that depends on what you're going to invest in, right? For me, I'm investing in all cash flowing assets because I need the cash flow now. Yeah. If I was trying to ditch my W-2 in 10 years, I might do fewer cash flow deals and more development and appreciation deals because I don't need the cash right now. So you really need to make that decision. What's my end date? Or, you don't have to quit the W-2 if you enjoy it, but it's nice to have it optional, right? Yeah. So that's the plan. And the snowball grows faster than you think. Those first few, you're going to be like, okay, I got a couple $100. And all of a sudden you say, oh my gosh, I have a couple $1,000. And then it just goes up from there.
Beautiful. Beautiful. Well, let's if we can spend a few minutes. I want to hear more, or have you at least talk a little bit more about Left Field Investors. It's been an amazing resource for me over the last couple of years, and really want to expose our listeners to it as well.
Yeah. So Left Field Investors, as I said, we're a community dedicated to education and networking for people, and we have people in our group who are non-accredited and just getting into their first deal. And we have people who are in 150 deals. We have everything in between. And the nice thing is everyone helps everybody. It's a really collaborative group. And the person that's learned the most has been me, right? I started this thinking, I'm going to teach people what to do. I've learned as much from the person who's brand new as I do from the expert. But there's a lot of different things that we do at Left Field Investors. We have blogs and resources and articles. We have our podcast. We have a masterclass, which is for beginners that takes you from what is a syndication all the way through to how to vet a sponsor and analyze a deal. We do a lot of webinars now, almost once a week, and they're either lunch and learns, which are and they're free. It's just asset-based, asset class. Someone will come in and talk about a market or an asset class. And then we also have deal webinars occasionally. And those are, from our preferred partners, people we know, like, and trust. And we don't vet these deals. We're just exposing them to the community. Usually they give us better terms. So for example, if we hit a threshold of $500,000 invested through our community, individually invested, but they aggregate it, then maybe we'll get a 8% pref instead of a 7%. So there's a lot of those deal webinars, and those are also educational. We have monthly meetings. Those are all online. We have a bunch of networking stuff. We had our first in-person meeting, and it was, it was fantastic. We had almost 100 people, and 13 or 14 operators came and gave, talks, and we did a lot of networking, and there's just so much going on. We have partnerships with Visor, who I mentioned already. And then you mentioned how I'm in 95 deals. It's embarrassing. I don't know the real number because I haven't figured that out yet. But the reason it's so many is because I use this company called TribeVest, who's a really great partner of ours, and they allow you to invest as a group. They help you. It's just a platform that helps you invest as a group. So what that does is a few things. One, if you have $50,000 to allocate in a year, if you're just doing it on your own, you'll get into 2, maybe 1 syndication. But if you're in a group and everyone's contributing 50 grand, you could get into 10. And then what happens is you're diversifying. But the best part about it is we talk about community and how powerful that is to have a community. But then if you have a smaller community, that's almost like a mastermind. If you, Randy, and 8 other people, you, me, and 8 other people are investing as a tribe through TribeVest, right? And I bring a deal to everybody, they're not just going to say, oh yeah, let's do it, right? You're going to ask me all kinds of questions, and I'm not going to be able to answer all of them. And so I'm going to go ask somebody and learn something. And then we all become better investors. And that's the true power of the community. And that's, those are just some of our partnerships in Left Field Investors. And we have, we also have a paid group called the Infield. And that is where it's $199 a month, or I'm sorry, a year, $199 a year, pretty affordable. And with that, I think the favorite thing that people get out of it is the forum, where people are constantly talking about investing strategies, sponsors, deals, all kinds of stuff is in there. There's several posts a day in there. We also have some investing tools that'll help you. And we do some networking inside of that group. And for 2023, there's a bunch of initiatives we're working on. We're working on a sponsor review tool where you can go in and, do a Yelp review for sponsors and things like that. So there's a lot of things we're working on. We're growing. We joke about it, but there's 5 founders and we're just 5 guys trying to figure stuff out. And none of this was intentional, but I think we've grown a pretty great group. And the thing I will say about Left Field Investors is, and I said it earlier, I cannot state enough how important it is in this type of investing is to be part of a community. And that community, the culture of that community needs to match your personality, right? And there's different communities. I'm in a couple different communities, and I recommend people, if Left Field Investors isn't for you, that's great. Go find somewhere that is for you, because it really, really accelerates your learning and accelerates your wealth building.
I love it. Yeah. And I think the just amazing growth that Left Field Investors has seen over the last couple of years is really a testament to you and the co-founders and that giver's gain mentality, that you guys came to this you weren't trying to make a buck in the investing community. You were just simply trying to educate and share and inspire. And that's ultimately what we're trying to do with this podcast as well, is educate and inspire the passive investor. And help give them the confidence to make that first investment in passive investing. So such a pleasure having you here. It was really, really great to have you on the show. Couple of questions, though, I do like to finish with, if we can. I'm curious, can you suggest any books, or have you come across any favorite books in the passive investing space that you think could be valuable for our listeners?
Absolutely. Hands down, the best book that I've found is The Hands-Off Investor by Brian Burke. Yeah. That is perfect for beginners and perfect for super experienced people. That, I try to read books and I usually get to like chapter 4 and I'm like, okay, next book. This one, it's dog-eared. I wrote all over it. I took 15 pages of notes when I read it. It's just phenomenal. It really covers everything, and it gets in the weeds, but it also has a nice overview. So I would recommend that. If you're going to be a passive investor, you got to read that book.
Hands down. Absolutely. What about, of course, your podcast is fantastic, but any other podcast that you love to listen to in this space?
Yeah, I like Hunter Thompson's podcast. He does a lot of overviews, economics, and things like that, and that's always good to hear. I like the Wealth Formula podcast with Buck Joffrey. It's very focused on certain things, but there's a lot of great ideas in there. So those are 2 of my top ones. I also like what is it by Josh McCown, Accountable Equity. I can't remember the name of it. I'm sorry, I can't remember the name, but that's a good one I like to listen to as well.
Okay, I'll look it up and put it in the show notes for our listeners. So, well, very good. Now, how can our listeners find you if they wanted to reach out or connect with the community?
Leftfieldinvestors.com is the best place. If you click on the button that says contact us, that goes right to me. You can also email me directly, jim@leftfieldinvestors.com. I have calls with 3 or 4 investors every day. It's not mandatory to join our group, but I can tell you a lot about our group and answer any questions you might have. And I'm happy to do that.
Awesome. Well, Jim, thank you again so much. You brought tremendous amount of value to my community. I greatly appreciate what you're doing for this space. So thank you so much for being on the show.
Thanks for having me. It was a pleasure.
Awesome. And to our listeners, as always, again, the goal here is really just to educate and inspire and continue that education process until you have the confidence to make your first investment in the passive investing space. And once you do, we're so confident that you'll be coming back for years and years to come to the space. So thank you again for listening today, and we'll look forward to having you on another show.
Well, there you have it, ladies and gentlemen, another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.